Alright, so where we stand right now is that we have prepared the financial statements, which I realize you guys hadn't actually prepared any with me, but you are going to prepare them in your homework section, so hopefully that helps. Hopefully my explanations help you to do the actual preparation. What we do at this point is we've got to do closing entries. So imagine that you've done all of your financial statements, you're ready, you've put them out there to the world. And it's December 31st, and they're done. The year is done, financial statements have been listed, we've got our income statement with all of our revenues and all of our expenses. Well, here's the thing. Let's say we're using a calendar year company from January 1st through December 31st. Well, we would record all of the revenues and the expenses from January 1st through December 31st. But on January 1st of the following year, we're going to need everything to get put back to zero so we can start again with the new year. So what we have to do is we have to close out all of the revenues and the expense accounts and close out that net income number out to retained earnings. Alright, so it's a 4-step process. The first step, we're going to close out revenues to expenses. We're going to close out revenues to this new account, income summary, which I'll show you in a minute. You're going to close out expenses to income summary, then you're going to close out, that's step 2. Step 3 is you're going to close out income summary to retained earnings, and the 4th step is you're going to close out dividends to retained earnings. Okay? The income statement accounts, the ones that we're closing out, are temporary accounts. They're referred to as temporary or nominal accounts because we only hold amounts in there for 1 year and then we reset them back to zero. So as you can see, they are in fact temporary. Balance sheets accounts, on the other hand, are called real accounts because they don't change from year to year. Your cash on December 31st will be the same amount of cash as you have on January 1st. The amount of buildings that you have on December 31st, presuming you didn't sell any, is going to be the same amount of buildings you've got on January 1st. So balance sheet accounts are called real accounts, whereas income statement accounts are called temporary accounts because we do reset them. Okay. So rather than going through the slides, I think I'm going to do this on my paint pad here. Oh, we should clear this. No. Okay. So our first step in this process is to close out revenues to income summary. So my journal entries are going to be, I'm trying to decide where I want to put these. Actually, you know what? Let's do this in T account format. So let's say we've got revenues currently with a balance in there of let's say 100. Well, we're going to keep it simple so I don't have to do too many numbers. We'll say we had revenues of this whole year of what, $1,000. Okay, so let me put $1,000 in here. This is what our account looks like right now. You've got revenues of $1,000. And we also have some expense accounts. We'll just do 2 just to keep this really simple. Wage expense and let's say utilities expense. Now you'd have many expense accounts. We're just going to keep this really simple for this explanation. So we get rate, let me draw my T's. Let's say in wages we paid out, let's say $500 this year. In utilities, we'll say we paid out, I'm just making this up as I go along, let's say we paid out $200. Okay, T accounts have been drawn. And let me put in the amounts. I said $500 in wages and $200 in utilities. Okay, this is what it looks like right now. We've got revenues of $1,000, you've got expenses of $500 here and $200 there. So really you're looking at $1,000 in revenues minus $700 in expenses. So our net income is basically what we made this year was $300. Okay, and I'm also going to make one more T account, well actually a couple more. I'm going to make a T account called income summary. Get that right. As well as a T account for retained earnings. It's a little bigger than I want it to be. Retained earnings. And last but not least, we're going to have a T account for dividends. Okay, I'm going to put you on pause while I draw my T's. Okay, so here's where we are. Miraculously, T accounts have appeared. Let's talk about this income summary account. This income summary account is solely used for the purpose of closing entries. It is not used at any other time. It doesn't show up on a balance sheet. It doesn't show up on an income statement. It doesn't show up on a statement of retained earnings. It shows up nowhere. It is purely used for closing entries, and it's just basically a temporary holding account. All right, you'll see how we're going to use it in just a moment. So here we are. We've got revenues of $1,000. What we need to do is we need to reset this account to zero so it's ready to use for the following year. So if we've got a $1,000 credit balance in here, the only way to make this account zero is to now debit it for $1,000. Making this account, I may not have made my keys long enough, but making this account now zero. Okay, so what I had to do is I had to debit revenues. Maybe I'll try to do it like this. Debit revenues for $1,000. And what I'm going to credit is I'm going to credit income summary. Oops. Let's make that work. Income summary for $1,000. Okay, so this is going to be basically an account where I'm using for my closing entries, where I'm going to close my amounts out to. Okay, so I debited revenues in order to make the account zero, and I credited income summary for $1,000. That's my first entry, is to close out revenues. My next entry is going to be to close out my expenses. So here we go. To close out wage expense, I've got a debit balance of $500 there. The only way to make this account zero is to now credit it for $500. And the same thing with utilities expense. I'm going to credit that for $200, making each of these accounts now zero. So here we go. I'm going to draw my lines and put my zeros in. 0 and 0. Alright, and what I'm going to do here is I'm going to put them into my income summary. So if I credited my expenses in order to make them zero, I'm going to put those amounts now into my income summary. Alright, so this is what the journal entry part of it looks like. We're going to debit income summary for $700. Okay, and we're going to credit wage expense for $500 and credit utilities expense for $200. I have now just reset my expenses to zero. They're ready for next year. Now what you've got here in my income summary account is really what you have in here right now is net income, if you think about it. You've got the $1,000 minus $700. You've got $300 in there, which is how much money we said the business made this year, basically. Net income of $300. Here we go. So our third step in this process is now we're going to kill off this income summary account. We don't need it anymore. We've now accumulated all of the revenues and all of the expenses in here, and we're left with a $300 credit balance. Well, in order to reset this guy to zero, we're going to have to do the same thing we've been doing, and we're going to have to debit it for $300. I'm running a little bit out of space here. So what you're going to have in this account is now going to be zero. Oops, I think I just lost my dividend, my DS. Let's put that back. Alright, close enough. You get the idea. Alright, so what we've gotten here now is we debited income summary for $300 because we're resetting that back to zero since it was purely a temporary account. And we're going to credit our retained earnings. We're finally doing the part where we put the net income into retained earnings. We keep talking about how net income winds up in retained earnings. This is the moment right here where it goes into there. So we're going to credit retained earnings for $300. Now, if there was amounts in here before from a previous year, then you would be adding to it. Let's say you had $10,000 in here from last year. Well, then it would be $10,000 plus this year's $300, and your balance would be $10,300. Okay, but in this case, I'm saying like it's a new business. We have no retained earnings, just keeping it simple. So you've debited income summary and you've credited retained earnings for the $300. You finally put net income into retained earnings. The last piece of this puzzle, right, so you've got 1, 2, 3, and we've got our fourth journal entry. The fourth entry is to close out our dividend account. And let's say with dividends, we had $100 in there that we paid out to our shareholders, okay? What we're going to do is we're going to do the same thing we did before, but we're going to go directly to the retained earnings account, okay? You're not going to use this income summary anymore. So, in order to close out our dividend account, we're going to go with the same methodology. We're going to credit dividends for the $100. I draw my lines. We're going to credit dividends for $100, and we're going to debit, retained earnings for $100. All right, so here you are. You have the $300 you kept you made in the business. That's your net income minus the dividends that you paid out, which makes sense because this is the money you made in your business, your net income. You decided you're going to take $100 out and pay it out to its shareholders. So what you really, at the end of the day, retained in your business was $200. Oh, I think I just messed up my... Wait a second. There we go. I didn't want to lose my first entry there. All right, so the journal entry, what that looks like is it looks like a debit to retained earnings for the $100 and a credit to dividends for $100. And there you have your closing entries. What you've done is you reset revenues to zero, you reset expenses to zero. You used income summary as a tool, right? But it's zero also, which is fine because it's the only, we don't want this account to ever have a balance in it. It's just used for these closing entries. We've put in our net income less our dividends, so basically the retained earnings, the money that we retained in our business, we recorded that into, we finally dumped that into the retained earnings account, and we reset dividends to zero as well. And that is the end of your closing process. The very last step in this whole thing now is to prepare one more trial balance. And it's called the post-closing trial balance because it's after these closing entries. And once you've prepared the post-closing trial balance, the only thing that you'll have in there now are balance sheet accounts because all of these revenue and expense accounts, these income statement accounts, have been reset to zero. So the only thing, again, that you're going to see in that post-closing trial balance are going to be balance sheet accounts. And you're done. And that's it. End of chapter 4.